welcome to the Brisbane Private Wealth Quarterly Market Update. Once again, I'm joined by Steve Garth. Welcome, Steve.
Yeah, hello, Rob.
Be fair to say that we're living in some very, very interesting times at the moment.
Well, it's definitely the most volatile that we've seen for a long time out there.
Yeah, if we were standing here probably January, we'd be talking how good a year it's been. Now we are, start of April. The last week has just been phenomenally volatile. Tell us a bit about what's been going on.
Well, first of all, you're absolutely right. By the start of the year, everything was looking good. Markets hit record highs. But on top of that, even though some people were saying, oh, it's a bit frothy, no one could have predicted this. But of course, Trump had just got elected back in November, and he came into power in early January. And of course, he brings in the talk about tariffs. And if you like, since the 1st of January, the whole market has been obsessed with Trump, tariffs and trade wars. It's led to really tumultuous times, which has really hit the head in the last couple of days. When you have a look at the chart here, Rob, it's of the US market. Now, normally we would show the S&P 500, the main American index. But here I'll split it up into the two major constituents of that, which is the NASDAQ. And that's where those high-tech stocks you hear about, Apple, Google, Nvidia, they all reside there. The New York Stock Exchange also makes up a good half of the S&P 500, and that's where the older industrial stocks live. And when you look at the chart here, you can see that, look, over the quarter, at least until March the 31st, the New York Stock Exchange stocks are doing okay, up a couple of percent. But look at those NASDAQ stocks, down by 10%. That's what they call a correction. Now, a few days after that, they're down another 10%. That's fair market. The NASDAQ stocks were 20%. And when you and I are recording this on a Thursday after Trump announced overnight that he was pulling back some of those reciprocal tariffs, or all of those reciprocal tariffs, except the ones on China, for 90 days, the market has bounded in a way we haven't seen since the end of the GFC. So the returns we've got there are still about where the market is now. The S&P 500, it's down about 6 or 7% year to date. The NASDAQ again down about 12% year to date, and the New York Stock Exchange it's down, but just a little bit.
So why have the NASDAQ stocks been hit so hard?
Yeah, great question, Rob. There's two reasons, really. First of all, the tech stocks, which are growth stocks, tend to be a lot more sensitive to interest rates and inflation. And the thing about tariffs is that they're inflationary. So if for the US and potentially the rest of the world. So if Trump goes ahead and implements all the tariffs as he suggested before he's rolled them back, then that's quite inflationary, and the tech stocks don't like that. But that's only one reason. The other one is you can see that the biggest stock on the NASDAQ, or one of the biggest stocks on the NASDAQ, is this company called Nvidia. They make chips for the artificial intelligence sector. I don't think anyone had heard of Nvidia 2 years ago, but you can see on the chart here, it had a return of nearly 180% last year. In February, it hit its peak, but at that time, the Chinese launched a competitor AI chip, which was cheaper, faster, more efficient. And suddenly the market said, oh, we just thought Nvidia would keep going on and on. Maybe we've been a little bit enthusiastic about the amount of money they've been pouring into this when someone else can come along and do it cheaper. So Nvidia has fallen by 20%. Now, again, it's fallen by a further 20% after March the 31st.
Recently,
But last night, it bounced up by, 15%. So it's so hard to read anything into what's going on right now. But that's why the tech stocks are certainly being more volatile than the other stocks.
What about our current market here in Australia? What do you make of that?
Yeah, so we've also been dragged down. Obviously, talking about the last couple of days, we're in the same volatility that the rest of the world is. But even before that, you can see in the chart here, again, the ASX hit its peak in February, also started to come off. Now, that's not a direct result of tariffs, because the tariffs being imposed on Australia at this point, a 10% tariff, will have very little effect on the overall stock market. It will affect some industries like beef, but it won't have a big effect on the stock market. What does have a bigger effect is, say, the uncertainty that tariffs bring to the global economy, and the Australian economy is kind of puttering along. We've got the slowest growth that we've had for decades here.
Yep.
So the market's been coming off since February, just on really slow growth.
Yeah. And interest rates, another interesting one, and very topical. Jim Chalmers said their expectation was about 4 rate drops this year. Now, with what's transpired in the last week, I guess, where do you see interest rates going?
Dr. Chalmers was probably right up till the end of March.
Yeah.
Again, the slowing economy, what central banks need to do when
Yep.
economies slow is to lower interest rates to
Yeah.
keep it going. That's all being thrown into the wind a little bit because, again, these tariffs are inflationary, but we don't actually know what the tariffs are going to be.
Yeah.
So it's really uncertain. If the tariffs come in as they were first pronounced on Liberation Day on
Yeah.
April the 2nd, and Trump stuck to that, that's very inflationary. And you saw bond yields going up and up and up. Bond yields are the best representation of the expectation of what the market sees happening. And so where we are now, Rob, is central banks are getting a little bit stuck between a rock and a hard place.
Yep.
Tariffs are causing economies to slow.
Yep.
Oh, I need to cut rates. But the tariffs are always also causing inflation to rise. Oh, I need to raise rates, or at least I need to keep rates on hold. I'm not much of a forecaster. I think the RBA will be forced to cut rates in May because I think the slowing economy will outweigh the potential inflation. But they could also leave it on hold as all this uncertainty needs to play out.
Yeah. Going back to what we talked about at the start, the US, if we look at the last week, so we had 2 significant down days, 5% drops day after day, and then overnight, a 10% return. We're telling our clients, obviously, we're in volatile times, and trying to time the market is almost impossible. We just don't know what happens next. So what can you tell us about these periods, which we've experienced before, of course, with this level of volatility?
Yeah, first of all, Rob, it is kind of important to realise that this is extraordinary volatility we're seeing.
Yeah.
I would probably say the GFC in 2007, 2008, COVID in 2020, and this are the most volatile periods we've seen. They're all sort of related to uncertainty. When the banks collapsed in 2008, no one knew how far that would go. That could be the end of civilization as we know it because we rely on banks. COVID, of course, literally could have been the end of civilization as we know it. Anyone who's seen, The Walking Dead or, 28 days later, that's kind of what we were thinking for a couple of days there.
Yeah.
And this one, strangely enough, it's tariffs, but so uncertain how they're going to be applied.
Yeah.
The market just doesn't know what it means. But in all of those, well, in the prior 2 cases, what was the best thing to do? It was to stay in your seat. Don't change the portfolio. And right now we're in this period where whatever you do, don't touch your portfolio. It's probably best not to look at the portfolio and just to let this play out. Being disciplined and staying in the portfolio that's been designed to meet your goals, it's the most powerful way to actually meet your goals at the end.
Yeah, and remembering we're diversified, so we don't have all our eggs in one basket. We're across different economies. Invested through Europe, the US, Australia, and also in the bond market.
And the bond market. That's
right. That's good advice. Thanks very much. Well, thanks very much for listening again. Again, volatile times. If you've got any queries, any concerns, please pick up the phone or shoot us an email. We'll speak to you next time. Thank you.